I do want to touch on M&A and partnerships for a bit because Zapier thrives on partnerships. You integrate with, I think I wrote it down, 9,000, more than 9,000 companies. Do you have any good stories about negotiating any of those partnerships?
Yes, it is 9,000 plus, and it's a lot because you ultimately end up with 9,000. Certainly, you can't give all of them any real attention. You have to sort of decide where you want to spend your time. And it kind of speaks to our last conversation that we had way back when on this like two-way door concept. We had a partner who was growing in popularity, and we had a handful of enterprise deals that were using this partner, but they weren't on the Zapier platform. Generally speaking, what we do is we ask the partners to build the integration. We say, hey, look, you got to build this, you got to maintain it, keep it up to date. There's certainly a lot of advantage for you. It's good for us as well. Like it's the shared sort of ecosystem. And in this case, they didn't have a live integration. We ask when they do build it, they have to sign a developer agreement that sort of conforms to our terms and such. And we'd ask them and they kind of were unresponsive. Like, yeah, didn't really give us much attention. But we had a bunch of enterprise customers come through and they were like, wait, we use this partner. We'd like it to be, available on Zapier. And so we do have the capability, if it's a public API, to build the integration privately for a customer. As long as it's an open API, we can do that, no problem. And we do it all the time. And so we built a few. We had that sort of continue to escalate with more enterprise customers coming, asking for this. We kept building it. And at some point going, should we go ask the partner, like, hey, could you go do this? Got more people asking. This is a good thing for you and again for us. We sort of said, well, I don't know that we should, because the reality is all we're going to do is open the door to a no, when in reality, the benefit is there on both sides. So we kind of continued to build a few more. And then once we got to 10 or so customers with another 50 asking for it, I just emailed the CEO and said, I've got 10 customers using it already. I got 50 more who want to use it. We built it. I can toggle a switch on our side and it goes public. You cool with that? And he was like, yeah, go ahead. Not the whole sort of know when to ask for permission versus forgiveness, but recognize when you can sort of back up the request with a little bit of evidence to go along with it. That's sort of, I think, is an easy way to negotiate a partnership.
You've also done at least 5 acquisitions within the last 5 years, if I'm counting right. How do you think about the M&A side and doing the math in a process? What does that look like, and what's the minimum model you need to feel comfortable?
Yeah, not too dissimilar to the conversation we just had on sort of trying to be a little bit narrow in how you define the sort of the thesis and build the model. Ultimately, we're going to look at the things that everybody's going to look at, the core ones, growth rate, trajectory, the components of that growth rate, cohorting that out, customer cube, understanding retention and how that's improving with newer cohorts, comparing that to comps in the market, trying to come up with this sort of range of what we think is a reasonable price, looking at the structure and ways in which that aligns incentive and what the market would demand in terms of how we would structure it from a cash versus stock perspective. We've got a lot of smaller ones, a lot of acqui-hires, explored some larger ones. And as you would expect, you see patterns in the data that will lead to a whole bunch of other questions. And we were chatting with the target and we saw decelerating growth in a segment. And we saw this interesting pattern in the funnel where activation was starting to drop off. That obviously prompted some questions, and it sort of kind of came back and said, what's going on? In that scenario, I got a story around, well, we made these price changes and we recognized after the fact they were the wrong ones. And now we have to undo this. And so it kind of comes back to the same conversation around like, is it the metric? Is it the measurement? Did something go awry or the way that you're attributing something? So you kind of have to double click through those things and get to the answer. In this case, we were able to isolate those cohorts of sort of post price change and look at, okay, let's look at the retention patterns of the ones who came in then and after, and then compare. And you could clearly see and delineate and say, okay, you're right. If this hadn't been the case, funnel would have looked like this, activation would have looked like that. If you're going to reverse these changes at this date, we can put that back in the model and assume that's the case. But ultimately, yeah, it's try to find the right place to draw the line, understand these changes that can shift your perspective on the potential in this sort of like management case versus your own internal case. But yeah, we stick to the standard ones and try to build something that's mostly based on those drivers. Again, that would change your mind if it wasn't true.
Would change your mind if it wasn't true. It's so well encapsulated. So let's say you do get comfortable with the performance data. How do you think about the balance of cash versus stock in a deal?
If the business is being acquired to run completely standalone, if the business is IP only, if it's full integration, those things might not sound like reasons for cash versus stock consideration, but the reality is the way in which you are trying to align incentives changes with each of those. Obviously, stock is a natural incentive, and it might serve the purpose of vet retention versus, let's say, cash plus a designated retention program as part of the acquisition. So there's a bunch of different ways you can sort of square it up. We'll kind of look at that alignment and trying to get incentives in the same place. Candidly, it comes down to cost of capital. We have been profitable for our entire history. We don't have a lot of the pressures that would sort of force your hand one way or the other. And so we do have the benefit of saying, well, we can fund a good chunk of this or all of this with off the balance sheet. Yep. Or we can go raise, or we can go get traditional or hybrid debt, kind of starting with that incentive alignment piece. We're looking at what the markets are allowing for. Today, growth markets are pretty dry, right? Unless you're AI native and on a 100% year-over-year tear, it's looking at the cost of traditional debt and really comparing that weighted average cost capital to, oh, what if we fund this internally? And then factor that into the different sort of dilution considerations, so on and so forth. And that's ultimately how we try to balance it. The other thing that's interesting is you also have to consider, well, how do we anchor our price in that deal? And what comps do we have? And again, Zapier, unique position. We don't have financing rounds to point out to say, oh, well, look, right here, 6 months ago, we were at this. This is what you're going to get. We kind of have to go, well, there's a 409A value. It represents fair market. And there's these other things and makes it a little tricky.
Maybe a good question to end on here, because this has been a blast. What do you think is the CFO's role ultimately in M&A?
One of the most important parts is to show up early in the process.
Okay.
Don't wait to be the diligence person. It's very easy. Founder-led company, product-led company. We really care about customer sort of success and everything. It's easy to kind of get attached to an idea and really believe in the vision and get emotionally sort of committed. And then you dig into the financials and you dig into the reality of it, and it starts to turn the other way. And kind of reversing that, okay, slow down, is harder when you're later in the process. And so you got to be upfront as part of it, helping to screen the opportunities. How I would frame it is like the cost of being wrong. Put a little fear into folks. Yeah, I love it. Like, hey, this is cool and exciting and great, but let's talk about what could go wrong, both internally, cost of distraction, and externally. This business goes the opposite direction, or things don't trend the way that we expect, or the synergies aren't as great as we're hoping for. Try to be early, try to be part of that screening process. Don't just wait to the very end and say, hey, we want to buy this. Here's what we're thinking. Help us get a price and do some diligence.
Here's a growth tax that nobody talks about. Every new pricing model you ship creates a nightmare for your finance team. Usage-based pricing, now you're tracking usage against commitments. Product bundles, now you're untangling what to recognize and when for every line item. Mid-cycle upgrades, good luck manually reallocating revenue. The pricing strategies that drive growth are the same ones that break your finance process. Right Rev turns that irony into a competitive advantage. Your product team can ship new pricing without asking finance for permission, and your sales team can close deals without worrying about downstream chaos. But I've seen too many companies where sales are celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. It's actually me. So here's a good place to start. RightRev built a free tool at calculator.rightrev.com. It scores your RevRec process, shows what's exposing you to risk, and tells you exactly where to focus before it bites you in the rear. Probably explains why your last close took so long. Check it out at calculator.rightrev.com. All right, without the Boston accent, calculator.rightrev.com.